one of the most important things to realize is when you're going to sell a business, it's important to sell the real estate or monetize the real estate before you sell that business.
Welcome to Price Discovery, Money and Mindset. Go under the hood with Jordan Rodriguez, a certified financial planning professional and certified exit planning advisor, as he explores the art of balancing wealth with personal fulfillment. We'll hear strategies and stories from industry experts, business owners, and thought leaders about navigating the complexities of high net worth families and businesses. Without further ado, here's Jordan Rodriguez.
Hello, friends, and welcome back to Price Discovery, Money and Mindset. Today's episode's a two-for-one. We've got Kevin Joseph and Blair Wood, both partners at Weber Wood Medinger here in Cleveland, Ohio. We discuss the unsung hero of the capital structure of businesses, real estate. If you're a business owner who owns real estate as a part of your enterprise, you need to tune into this one. Enjoy. Without further ado, we've got Blair Wood and Kevin Joseph from Weber Wood Medinger joining us. Thank you both for taking the time today. I'm really looking forward to this conversation. Actually, Kevin and I were talking a while ago about a number of different things, but I had this revelation midway through the conversation that we kind of do the same thing. I'm working with financial assets, you're working with real assets. And I think a natural starting point for today's conversation is the concept of who's at the table when we're talking about the professional team that's working with high net worth families and business owners. Kevin, if you wouldn't mind starting by just describing what your role at the table is.
Sure. So, much like you have clients throughout multiple industries, as do we, right? So the clients we generally service are in the RIA space, the private equity space, the family office space, and the family-owned business space. So we're either getting in the door directly through the four things I just mentioned, or through advisors like yourself, accountants, different people that are close to the bankers, that are close to the client and advising them. So our role is we are a financial advisor for hard assets, right? That's a great way to look at us, where you're working with, different stock plays and financial advice as it relates to money. We're doing it as it relates to hard assets. And people don't generally look or think of hard assets as a way to accomplish business goals, personal goals. And that's where we fit in. That's the role we play at the table, is we give an alternative approach to finding capital, many times cheaper than you can get traditionally, but also providing unique opportunities for our clients to look at different opportunities to expand their business and whatnot. So our role is a fiduciary role. It's a advisory role, and we're not selfish, right? We don't need to be the only people at the table. We like to work with people like you. We like to work with accountants. We like to work with different PE firms, family offices, and we just bring a unique piece to the table.
So Blair, in your experience, if we're talking about it through this lens, a smaller mid-sized business owner, why is real estate sometimes overlooked by that cohort of people as a solution or a complement to their capital stack?
Great question. There's a couple of reasons for it. I would say first of all, a lot of business owners that own their buildings see the asset on their balance sheet, and it's depreciated over the years, and they'll have some idea in their mind of what the value of that asset is. When we get into our value enhancing value add strategies, which include sale leaseback, the nature of a net lease creates value that is oftentimes above and beyond what a bank appraisal would be, and certainly above what book value would be. And we can touch on that later. I think that we'll get into the mechanics of the net lease concept later. But I would say, secondly, there's an emotional attachment that a lot of family business, and this is applicable to people that have built the buildings and built up their company. There's oftentimes an emotional attachment to the building itself. It represents what they've built, and so parting with these real estate assets is a touchy subject for a lot of owners.
Yeah, I think people sometimes forget. I mean, we talked about how you guys advise on real assets, and I'm not just putting real in air quotes. There is something tangible about the facility that you built a business in or the piece of real estate that you own. And it's easy for us to sit behind the computer and behind our spreadsheets and say this is the best thing to do. But the emotional component is huge. Now, Blair, you alluded to it a little bit. And before we talk about some of the different mechanisms for creating liquidity with those real estate assets, I'm going to open this up to both of you because it's kind of a multi-pronged question. What are some instances that would lead a business owner or high net worth family to want to create liquidity with some of the real estate assets on their balance sheet?
So, Blair, do you want me to take that? So, the majority of the time, the main reason people call us and look to monetize the real estate assets is to pay down debt, right? They have a balance sheet that's a little dirty. They need to clean up that balance sheet. They look at a variety of different ways to try to do that. But again, a lot of people don't think of the real estate as an opportunity to do that. So they give us a call, we come in, and we're able to monetize those real estate assets to help pay down debt. Additionally, we have clients that have partners that are looking to buy out. Using real estate to buy out a partner is a great use of funds, as well as expanding a business line, right? Or really even the facility. So some people will look to a financial real estate partner to add another, 50,000 square feet of production or manufacturing. Some will look at real estate to use those funds to deploy a new profit center. Maybe a food company is looking to get into a new juice line. Real estate proceeds can be used to fund things like that. So in a nutshell, I think the main reason we get calls is there's an issue with the balance sheet, and real estate is a way, monetizing real estate is a way to clean up that balance sheet.
I might add another significant application, and why we're brought in on the front end, like for a private equity group, you're really anyone buying a company. When owned real estate is transferred with the opco on a new platform, for example, there's significant opportunity to use that real estate as part of the capital stack when acquiring the business. And again, it goes back to the concept of, well, the real estate is on our books for this number. When we take a look at it, we say, well, we could do a sale leaseback transaction, and you could pick up an arbitrage of, a significant number to help put into your capital stack. And we've had great success in that vehicle for people acquiring companies.
And Jordan, and what the value we bring in that, and what the service WWM offers is, we call it pre and post acquisition due diligence for the real estate, right? So what Blair was alluding to, when a private equity company is going to acquire a portfolio, a Cleveland private equity company is going to acquire a portfolio company in Tampa, Florida, let's say, right? They'll give us a call and say, hey, Kevin, Blair, team, can you guys come in and kind of do a valuation on this real estate? It's owned real estate. We're not sure if we want to own it or not. Can you show us the economics of if it makes sense for us to acquire this with the purchase of the operating company and then maybe flip it to get some arbitrage? So that's the pre-acquisition front. There's also post-acquisition. So PE that we get engaged with might have 7, 8, 9 different portfolio companies with locations all throughout the country with owned real estate, and they want to monetize that real estate. That's when they give us a call and say, hey, we're thinking about selling this business, but before we do, we want to monetize the real estate assets so we can participate in the arbitrage. And that kind of leads me into a segue, Jordan, if you don't mind. A lot of our clients, one of the most important things to realize is when you're going to sell a business, it's important to sell the real estate or monetize the real estate before you sell that business. For example, if ABC family-owned business owns their real estate and they're going to sell their company, they should monetize the real estate asset before selling that company, because that next PE owner of that business is just going to do what they should have done, right? Which is monetize that real estate. So it's kind of like Blair and I like to think of it as like a double liquidity event almost. You're getting
Sure.
liquidity from the real estate, then you're also getting liquidity from the opco. But that just kind of fits into our pre and post acquisition due diligence world as well.
Great. So it doesn't sound like we've explored this a couple of different times, but um, you're not waiting for somebody to call you and say, hey, we want to do a sale leaseback or something. You're getting involved in the process early and often and advising not only the transaction itself, but the lead up and the preparation, which I think is lost on a lot of people. And I'll be the first to admit, when we started working together many years ago, I kind of didn't know exactly when you fitted in the process. And I learned very quickly that it's as early as I can involve you in the process, because you just make all the conversations a lot easier. You advise on things, even if you don't end up in a situation where the client is ready to do whatever it is that the recommendation is in the next 6 months, whatever that time frame may be. You guys do really take the baton from the beginning and carry it all the way through post transaction.
Correct. And if Jordan, back to your original point, if we waited for someone to call us, the lights wouldn't work in our office because no one will call us. But we're conversational. We try to be value add. We're very fortunate. We've been in business since 1968, right? We have a very select group of clients. We don't want 1,000 clients. We don't need 1,000 clients, right? So we're fortunate to be in the position that we can pick and choose the deals we want to work on. And prime example, when we worked with you and you brought us in for your one client, I think it was out there in Ashtabula, if we can add value, we're coming to the table and we're going to add value. But if we're at the table and we realize we can add value, we're going to be the first people to tell you, and we're going to find someone else that can add that value. So real estate is a great business to be in when you have the reputation, the resources, and the connection that we've been fortunate to build over the past 50 plus years.
Sure. Just another parallel between what I see you guys doing and what I perceive the value that we're bringing to our clients as well. And Blair, you mentioned this a couple of times, but sale leaseback, that's going to be one of the most important mechanisms that we'll talk about today. So to set the stage, if I'm thinking about creating liquidity from the real estate holdings, on one end of the spectrum, I could take my $5 million building and I could go to the market and I could sell it. And suddenly I have $5 million in cash. What is a sale leaseback, and what are some of the, what are some of the factors that make a sale leaseback a good choice for a business owner?
Sure. Well, so the example that you cited, where building owner lists his property and sells his property, no longer owns the property. New owner comes into the building and all he's got is $5 million for his building. He has to go find somewhere else to operate his business. With a sale leaseback, you are selling the fee interest in the building, in the property, land and building, and at the same time, you're taking a long-term lease to remain in the building. And like a typical sale leaseback term is 15 to 20 years. We've done some that are shorter, 10 years. We've done some that are longer, 25 years. But the sale leaseback, I like to look at it more like a financing vehicle than a typical real estate transaction. So you're extracting all of the equity and value out of the building. Seller gets the proceeds. Seller commits to a long-term lease commitment where the investor has a stable income stream. And this long-term lease that I described is the vehicle that really creates the value over a typical appraised value, or certainly over book value. So we tend to think they're less real estate deals, more financing deals, and for all the reasons that Kevin mentioned earlier. What to do with the proceeds: pay down debt, buy out a partner, acquire a new business, buy any number of corporate purposes. But usually it's pay down debt or fund acquisitions.
So there's the short-term liquidity that the original owner gets in the form of cash, but they also get to continue operating in that building, which obviously they wouldn't get to if they sold the real estate
So
outright.
good point. I should have touched on that more. You continue to operate the building. There's uninterrupted occupancy for the seller and then future tenant. So it's as if they own the building. Nothing changes as far as their operation goes. If you do a 15 to 20-year lease with renewal options, so most groups that enter into a sale leaseback deal have guaranteed rights on the building for 20, 30, 40 plus years, certainly that would outlast most owners' expectations on how long they're going to how long they're going to own their business.
And that's important, Jordan, right? So for your clients in particular, private equity clients, people that own businesses, which I'm sure a lot of your clients, control is everything. That's the main pushback that we get, right? I'm losing control. Not really, right? The way a sale leaseback is structured, as Blair just pointed out, is that it's as if you own the building. So you can control the building into perpetuity if you really wanted to through renewal options, right? In the same vein, when we're dealing with our private equity firms, their main concern is change of control, right? So when the time comes to sell the business that they've been running for the past 5, 6, 7 years, however long their hold period is, are they going to have restrictions on if they're going to be able to sell? And we have built in all the negotiations and all the leases that we've done for our PE clients language that allows them to transfer that business to an equal party or some financial metric that's in the lease. And that's important, right? So in 25 plus years of kind of sale leasebacks being popular, we've, knock on wood, have never really run into an issue where control has come up as a driver to stop a deal. And that's important for PE and your type of client, business owners, to know that it says if you own the building and there's not really many control issues.
Sure. Yeah, it sounds like one of those rare win-wins that you don't really see out in the wild too often, where the original owner gets their money up front. They get to, they get a long-term guaranteed sort of tax deductible business expense in the form of leasing a building that they're just paying rent on an ongoing basis. There's no lapse in control. But even from the buyer's perspective, when they buy that original building, it's no different than buying some sort of pretty sticky revenue generating real estate holding that's contractually sound. They have a long-term tenant that they know is motivated to continue operating in the space. It's really interesting. Now, I'm assuming that no two deals look the same. What are some of the more negotiable aspects or different levers that can be pulled in a sale leaseback, and how are they tailored to specific client goals?
So in terms of kind of where the negotiation take place, it's everything we do is based off the rental rate, right? So depending on what market you're in, we can push rents, we can go rents below market, we can stay at market, and it's really up to what our clients' objectives are, right? Because you'd think every client that we work with wants max proceeds. Well, that's not always the case, right? Some want to reduce operating costs, some want to do different things. So rent is a big negotiating topic as it relates to sale leasebacks. As well as, so if I can back up for a second and kind of maybe go through the structure of what a sale leaseback might look like, because I think it would be helpful. So general terms of a sale leaseback are anywhere from 10 to 20 years, ideally 15 to 20-year terms. In that term, you're looking at anywhere from 2.5% to 3.5% annual increases, probably falling around 3%. And then it's as if you own the building. So they're absolute triple net. So the tenant is responsible for virtually everything with the exception of a few foundational or structural issues of the building. The process that we run generally takes 60 to 90 days, right? So, our approach to the market in terms of negotiating is a little different than how our competition does it. So we base everything off of that net operating income or that rental rate number. We don't go out with a purchase price, right? Because that creates a competitive environment for our clients. We're not painting ourselves into a corner. We're not saying, hey, this industrial building is worth $10 million. We're going out with the NOI and we're letting the market tell us what that building's worth. And that creates a competitive negotiating environment for us because it brings multiple players to the table. at all different levels. And then we can kind of pick and choose, kind of a la carte, if you will, if we want to push rent, if we want to sacrifice rent for lower annual increases, if we want to get better partnerships with a certain REIT versus another REIT. So the fundamental structure of a sale leaseback is important to understand, because those are the levers you can pull as it relates to negotiation.
Gotcha.
Fair,
Now,
Blair?
Yeah, I would make one comment there, Kevin. You mentioned some sale leaseback, that there's some landlord responsibilities, and you said some structural things. With the deals that we do, generally there is absolute net, meaning that the seller, which is now the tenant, is responsible for building maintenance, insurance, roof, parking lot, structure, slab. Every single component that's associated with that building is on the occupant, which was the former owner. So these absolute net structures are just as they sound. The landlord has zero responsibility, other than, oftentimes you won't hear from your landlord for years and years and years, as long as you keep paying your rent. Or, the only times that you might have contact with your landlord in these situations would be if you need to, if you want to make changes to the building, significant structural changes. Anything over $200,000 has to have landlord approval. Those kind of things. They want to make sure that the integrity of the building stays the same. They don't want you going there and removing, braces, or doing things without the proper permitting, and so on and so forth. So, other than things like that, the tenant has full responsibility for everything associated with the property.
That's a great clarification. And I was more referring, Blair, to the landlord approval to do some type of structural change to the building. So
Gotcha.
That's a great clarification.
So, Blair, I want to go back to the concept of who's around the table. It sounds like this sort of transaction, you said 60 to 90 days, you guys are advising from beginning to end, but there's got to be, there's a legal component here. There's a tax component. Are there other professionals that are joining in throughout the course of this process?
Well, yeah, okay. So the buyers of these assets, REITs, PE firms that are focused on real estate, high net worth individuals, they're all going to do their underwriting very, very similar to how a bank does their underwriting when you go in and apply for a loan. There are, there can be covenants on coverage ratios, for example, that they want you to maintain, similar to what a bank might underwrite as well. We've found generally that any covenants would be less restrictive than what you'd see from a financial institution, but they can still be in there. As far as who else is at the table, attorneys, certainly, accountants, the people that we interface with, our customers, usually it is the CEO and the CFO. Those are the two main people that the buyers want to speak with when they're underwriting a transaction. They want to very thoroughly understand the financials. We have to provide audited financials usually, to the extent that they have them, or certainly reviewed. Who else might be at the table, Kevin?
I think you have your the people that are doing your environmental reports, your property condition reports. I mean, the team is big, but the decision makers from our client's perspective are the CFO and the CEO, which is our client, their accountant, and their lawyer. And it's important that you pick the right accountant and the right lawyer, right? Because while sale leasebacks are a great vehicle, you have to have the right team that understands the drivers and the levers to pull to move this forward. We've worked with plenty of deals with very sophisticated private equity firms and family offices that they've had the wrong lawyers or accountants at the table. And the difference between having the right people at the table versus not is huge. I mean, it's the process can get really choppy if you don't have the right people. And Blair will tell you this time and time again when I first started here, time kills deals, right? And we don't have the right people at the table, that 60 to 90 days starts getting longer and longer and longer. Then all of a sudden it's over, right? So that's kind of who we deal with in a nutshell.
Yeah, it's a natural transition to one of my next questions. Pitfalls, potential drawbacks, and hard lessons learned over the course of both of your careers. I always hate the framing, the cheesy, hey, if you could go back and tell yourself this however many years ago, what would you? But I think the framing is justified in this context.
I would say that, the market's always changing. Sale leaseback deals that we were doing 15 years ago, they're largely the same, but everything has changed over time. The underwriting, I think, has gotten more stringent. There's more people in the space right now. There's more competition amongst brokers and advisors. When we first started doing these kind of sale leaseback deals and having a corporate services real estate model, there were very few people in the space doing it. We would go to various functions, geared towards the private equity space, and we would be the only broker in the room. That's changed significantly. So there's a lot more competition. I would say that those would be the main look backs. I mean, we probably could have captured more at the time if we realized there would be, the level of competition in the space that there is now. But I have no complaints about that.
It's the thing about hindsight, right?
Yeah. I don't like to look in the rearview mirror, and think about what could have been. I think that's wasted time, but.
So let's look forward instead. In my industry, there's a ton of really prominent demographic, mostly tailwinds right now, but there are obviously always going to be certain types of headwinds. Is there anything that you guys see over the course of the next decade, let's call it arbitrarily? Again, from a demographic perspective, everybody's talking about the great transition of wealth that could either be a boon or maybe a potential headwind to your operations.
So the good thing about our business, Jordan, is we're agents of change, right? So when there's positive news, people want to do something. When there's negative news, people need to do something. And real estate is a great way to accomplish a lot of goals, both positive when you want to be proactive and also when you want to be reactive. So, the rate conversation in the short term is huge in our world. What you mentioned, the big transition, so to speak, of generational change in business ownership is huge for us. And it highlights the point that we made earlier about using this vehicle to fund partner buyouts, etc. We have clients today that are using a sale leaseback vehicle to purchase the business, right? So we have one client we're working with throughout the country that he will look for large real estate for businesses that are for sale, and he will bring us to the table and we will run a sale leaseback process, and he'll simultaneously close on the business while using the proceeds from that sale leaseback and as a part of the capital stack to purchase it. So that kind of gives you a little insight into, I think, where we're headed as it relates to the change in business ownership.
And I would add that I see more and more companies opting to lease versus own their real estate. Real estate is usually does not perform as well as a business's internal rate of return. The return on equity, they're not getting that same kind of return on the real estate generally, unless it's in certain locations around the country. Call it Inland Empire in California or the New Jersey, New York area, and things like that, where the rates have just gone through the roof. But in general, in the heartland, in the Midwest, and a lot of the places where we transact, it's been an underperforming asset. And so when you really drill down to the economics of ownership versus lease, I I really believe that going forward, more and more companies are going to realize that leasing is a better option, provided that you structure your lease the right way. You want to make sure that you maintain long enough control to achieve your goals. You don't want to be held hostage by your landlord, and that all comes down to your brokers and your lawyers helping you negotiate your best lease.
Yeah, and with construction costs rising, Jordan,
Yeah.
it's important for your individual clients and business owner clients to realize the benefit that what we bring to the table here is the buyers of these sale leasebacks are generally Wall Street REITs, which with some privately owned REITs or REITs elsewhere throughout the country. But a huge distinction is that when you're doing a sale leaseback, these REITs aren't just your landlord; they can be a partner, right? So that's where we add value in determining what partner is right for your client. So, for example, if you have a client that owns a 100,000 square foot industrial facility, right, and they have plans in the next 3 to 5 years to add another 150,000 or 50,000 or 25,000 square feet onto that building, with construction costs skyrocketing for companies now operating companies that maybe have historically lower cash volumes, it's better to go to these REIT partners who have a lot of cash on hand. There's a ton of dry powder at these REITs. So what these REITs can do is they can come in, you can do a sale leaseback on the existing asset that you have, and then they can build you a new building off of your balance sheet. They'll do it on their balance sheet. And the way that's the economics of that work is it's just built into the rent, right? So there's negotiations to happen there, but it's a great way for your clients to understand that they can grow on someone else's balance sheet and someone else's expertise. They bring the construction people to the table. They bring the different resources to the table and work with you through the process. But it's important that you pick the right partner, because there's a lot of REITs out there that will only hold the real estate for 2, 3, 4, 5 years. We can help pick and choose what REITs make the most sense, who are the long-term holders, who has experience in building add-ons to existing facilities, etc.
In addition to that, in addition to picking the right buyer partner that's going to grow with you and be around to you can expand with, there are also a lot of these partners that don't just invest in real estate. They will help you fund other business operations too. So, it's not just some of them are one trick pony. They own real estate and they buy real estate. And once you do the transaction, it's done. There are other partners out there that are in the business credit, lending environment, as well as being buyers of absolute net real estate. So they can operate as a landlord and as a bank virtually for some clients. And in fact, we've done deals where not only has the buyer bought the real estate, they have invested into the business and gained ownership in the business. So, there's a wide variety of buyers out there. And as Kevin said, we want to make sure that we find the right buyer for our clients' long-term goals.
Yeah, that's a really, really interesting concept that you're both bringing up. And admittedly, I had never considered that. I would have thought that every buyer is simply a buyer of the sale leaseback. But the whole idea of partnership, aligning incentives, having different people at the table who can now serve different purposes above and beyond just buying that sale leaseback is fascinating. And I think that's probably the best transition. The last question that I frame in a different way, depending on who's on the other end, but it's been consistent throughout all of the other episodes. You just debunked a misconception that I had. Are there any other myths or misconceptions that you want to debunk for potential future clients who might, and I'll tell you one, you already gave one, I have to give up control of the building if I'm entering into a sale leaseback transaction. So you can't use that one. You also can't use the one that you just debunked for me. Anything else?
I got one for you. We're a 50-year-old company, but we're a small company. And, there's less than a dozen of us here, and we go head to head with the likes of Jones Lang LaSalle and CBRE and Colliers and all the big guys that have tens of thousands of employees, and we win a number of those competitions. And I would like to say that picking your advisor, your partner, you should pick the individual and not the company. And when you pick us, you get us. It doesn't matter where the project is. It can be in the U.S., it can be in Canada, it can be in Mexico, it can be wherever. But when you select us, you get us. And that's how I think we compete well with the national firms. Yeah, bigger is not always better as far as head count of an organization.
Well said. Anything to add, Kevin?
Yeah, one thing I would say is maybe not so much of a debunk, but I think a nice parting thought would be, as we've talked about today, there's been a lot of information, but what we do is so much more than just quote unquote real estate, right? We're talking diligence, we're talking business acquisitions, we're talking add-ons, we're talking construction. We want to be a trusted advisor to our clients, to your clients, whoever it may be. And I think a parting question or a parting advice that I would give is everybody that owns a business that either leases the real estate or owns the real estate, everybody should know what it's worth, whether they want to do something with it or not, right? So what do I mean by that? Not only what is it worth, but what's the bank appraisal value of the building, and then what's the lease fee or the sale leaseback value of the building. In the same vein, what does the lease look like? Everybody should have a unique and in-depth understanding of if there's opportunities to purchase real estate in their lease, if they're below market rental rate, if they're above market rental rate. So the question I'd ask of you, Jordan, or the parting advice I'd ask of you is make sure your clients know what their real estate's worth, both sale leaseback versus bank appraised, whether they want to do something with it or not. And in the event they do want to do something with it, call us. You'll be the first person that actually calls us without them calling them.
To add on to what Kevin said, it's understanding your opportunities that may be there that you may or may not know about, and the risks that are associated with leases, for example. Having a firm understanding of what's in a lease. A lot of leases are 30, 40, 50 pages, and there's a lot of information in there. So having a firm understanding of the opportunities and risks in the leases is equally important to understanding what the value, both book value, appraised value, and net lease value. So there's more than just is it owned or is it leased.
Sure. Kevin, Blair, I really appreciate you both taking the time. I'll link your profiles and website in the show notes. But again, this has been a fantastic conversation. I really hope that some people listen and are evangelized to the idea of, Kevin, you said it, knowing what their real estate is worth. And hey, the phone could start ringing. People should use this as an opportunity.
Awesome,
excellent. Thank you very much.
Yeah,
thanks, guys.
Price Discovery Money and Mindset is brought to you by Wernick Wealth Managers and Chagrin Valley Business Strategies. Opinions expressed by Jordan and guests are their own and do not represent investment advice, solicitation, or the like. For more information and resources referenced in this episode, be sure to check out the show notes. Thank you and see you next time.